Two friends, same city, same year, same starting number, $150,000 in savings, sitting in a bank account waiting for a decision. Friend 1 does something almost boring. She opens a brokerage account, buys a low-cost S&P 500 index fund, and closes the laptop. No spreadsheets, no permits, no 2 a.m. panic about payroll, just nothing. She goes back to her regular job the next morning like nothing happened. Friend 2 does something that feels a lot more exciting. He spent years around cars, he's tired of making other people rich turning wrenches, and he's convinced this is his shot. He signs a lease on a 3-bay garage, starts pricing out lifts and diagnostic equipment, and tells everyone at Thanksgiving he's finally investing in something real, not gambling in the stock market. Same $150,000. Two completely different bets on the future. Here's the question this video is actually about. 12 months from now, which one of them is sleeping better? Because here's the uncomfortable truth almost nobody tells you before you sign a commercial lease. Owning a workshop isn't just a business decision, it's a capital allocation decision, wearing a business's clothes. And most people evaluate it with their gut instead of their calculator. By the end of this breakdown, you're going to know exactly what that garage really costs to open, how many cars have to roll through those bay doors just to break even, and where the hidden expenses are quietly waiting to eat every dollar of passive income your friend thinks he's about to make. Because right now, only one of these two people actually knows what they signed up for. Let's find out if it's him. So let's start where our friend started, with a number in his head. Ask most first-time workshop owners what it costs to open, and you'll get some version of the same answer. Maybe 60, 70 grand, lift, some tools, first month's rent. Confident, round, comfortable, and almost always dangerously wrong. Here's what that number actually forgets. A single certified 2-post lift installed and inspected can run $8,000 to $15,000, and most functioning shops need more than one. Diagnostic scanners capable of reading modern vehicle computers aren't a one-time $200 purchase anymore. The good ones cost thousands, and they need annual software subscriptions just to stay useful. Then there's the boring stuff nobody puts in the daydream. Garage keepers, liability insurance, business licensing, a surety bond in some states, workers' comp the moment you hire your first technician, initial parts inventory. Add a compressor system, alignment equipment, tool financing if you're not independently wealthy. Add build-out costs if that empty garage isn't already wired for 3-phase power. Now here's the number almost nobody budgets for at all. The one that quietly kills more shops than bad breaks ever will. Operating capital. Because even a well-run shop doesn't turn a profit in week 1. It takes months to build a customer base, get reviews rolling, and fill a schedule. Most financial advisors specializing in small business will tell you to have 3 to 6 months of fixed costs sitting in reserve before you ever unlock the front door. Stacker all of that together, and that 60 or 70 grand dream often turns into $120,000 to $180, 000 in real-world capital required, sometimes more, depending on your market and lease terms. That's not a rounding error. That's the entire gap between a shop that survives its first winter and one that doesn't. And here's the part that should genuinely unsettle you. Most of the owners who go under aren't bad mechanics. They're good mechanics who did great math on cars and terrible math on capital. So if the startup number is this misunderstood, you have to ask the next obvious question. Once the doors are actually open, how does this business make money in the first place? Because the answer isn't as simple as fixing cars. And the difference between the two revenue engines inside every shop is where most owners quietly sabotage their own margins before they even realize it's happening. Walk into any workshop, and you're actually watching two separate businesses running at the same time, wearing the same uniform. The first is labor. This is the mechanic's time, diagnosing, repairing, hands physically under the hood. It's high margin because you're not really selling a part, you're selling expertise and years of training. The problem? It's brutally capped. There are only so many bays, only so many technicians, only so many hours in a day. You cannot scale labor by simply wanting to work harder. The second engine is parts. Every alternator, every brake pad, every sensor sold with a markup. In theory, this one scales beautifully. Sell more parts, make more money, no extra bay hours required. But here's the twist most new owners don't see coming. Parts margins have been quietly collapsing for years. Customers can pull up the exact same part on their phone in the parking lot for half your price. Because online retailers don't carry your rent, your insurance, or your payroll. So which engine should actually drive your pricing? Most first-time owners get this backwards, and it usually starts with good intentions. Picture a shop owner. Let's call him Mike. Mike grew up in this neighborhood. Everyone knows him. And because everyone knows him, He prices like a neighbor, not a business. He undercharges labor because these are my customers, and he barely marks up parts because he doesn't want to feel like he's gouging anyone. 2 years in, Mike is exhausted, fully booked 6 days a week, and somehow still barely breaking even. Mike isn't bad at fixing cars. Mike is bad at understanding which engine actually needs to carry the business. He built his pricing model on being liked instead of being sustainable, and it nearly cost him the shop. This is the trap sitting underneath thousands of small workshops right now. Being busy and being profitable are not the same thing. You can have a full appointment book and still be quietly working full-time for free. So if being slammed doesn't automatically mean you're winning, what number actually tells you the truth? There's one calculation that cuts through all of it, one piece of math that instantly separates a shop that's thriving from a shop that's just busy pretending. And it starts with figuring out exactly how many cars need to come through those doors every single month just to survive. Here's where the illusion breaks, and the real number finally shows up. Every workshop has a floor, a monthly cost that exists whether a single car pulls into the bay or not. Rent, insurance, loan payments on that lift, a technician's base wage, utilities, software subscriptions for the diagnostic tools. Add it up for a modest 3-bay shop, and you're commonly looking at $18,000 to $25,000 a month in pure fixed overhead before a single wrench turns. Now here's the number that actually matters. Average profit per car. Not revenue, profit, after parts cost and technician time are accounted for. For a lot of general repair shops, that number lands somewhere around $150 to $250 per vehicle, depending on your mix of labor versus parts. So let's do the math our friend never did before signing his lease. Take fixed costs of $20,000 a month. Divide by an average profit of $200 per car. That's 100 cars. Every single month. Just to hit zero, not to get rich, not to pay himself a salary, just to break even. 100 cars a month works out to roughly 25 cars a week across 3 bays in a 5-day operating schedule. That's not impossible, but it means each bay needs to be turning over close to 2 vehicles a day, consistently every week all year, accounting for no shows, slow seasons, and the technician who calls in sick. And here's the moment that should genuinely stop you. A shop can look busy. Cars in every bay, phone ringing, a full schedule on the books, and still be losing money every month. Because busy measures activity. Break even measures survival. Those are not the same chart. This is exactly why so many workshops fail quietly instead of dramatically. There's no single explosive mistake, no dramatic collapse. Just month after month of being slightly under that number. 90 cars instead of 100, an average ticket a little lower than projected. Until 18 months later, the owner is out of savings and out of answers. Once you see this math, you can't unsee it. Every shop you drive past, packed parking lot and all, is silently running this exact equation in the background, and you now know how to ask it. Is this busy, or is this actually breaking even? But even shops that clear that 100-car number every month aren't necessarily safe, because there are costs sitting just outside the P&L, ones that don't show up until they've already quietly erased an entire year of profit. So say a shop clears the number. 100 cars a month, consistently, for over a year. On paper, this should be the success story, the shop that made it. And for 18 months it was, then 2 things happened in the same quarter. First, the best technician, the one who could diagnose a problem in 10 minutes that would take anyone else an hour, walked out the door for a competitor offering 75 cents more per hour. Replacing him wasn't just a want ad and a handshake. It took 4 months to find someone qualified, and during those 4 months, the shop was operating under capacity, while still paying full rent, full insurance, full loan payments. Revenue dropped. Fixed costs didn't. Second, and this is the one nobody budgets for at all, a comeback, a repair that didn't hold. The customer came back angry, the shop redid the work for free to make it right, and on top of the lost labor hours, it triggered a liability claim. One claim. That single claim caused the garage keeper's insurance premium to jump at renewal, a cost increase that quietly sat on the books for the next 3 years. Neither of these events happened because the owner was careless. They happened because these 3 costs, technician turnover, warranty comebacks, and insurance volatility, don't show up as a line item you can plan around in advance. They show up as damage after the fact, dressed up as just a rough quarter. This is the part of shop ownership that never makes it into anyone's pitch. Not the lease signing, not the grand opening post, not the confident conversation at Thanksgiving dinner. It's the year where everything looked fine on paper, book schedule, steady car count, 100+ vehicles a month, and still ended with less in the bank than the year before. So here's the real test of whether a workshop is a good use of $150,000. Not whether it can hit break even in a good quarter, but whether it can survive its worst one. Which brings us back to our two friends, because it's time to actually put their numbers side by side, and the comparison is not as one-sided as either of them expected walking in. Let's go back to where we started. Two friends, same $150,000 1 year later. Friend 1, the index fund investor, has done essentially nothing all year. And that's exactly the point. In a solid market year, her money has grown somewhere in the range of 8 to 10%, roughly $12,000 to $15,000, taxed favorably if she held long-term, fully liquid if she needs it tomorrow. She hasn't thought about this investment more than a handful of times all year. No employees, no liability, no 2 a.m. phone calls about a broken compressor. Friend 2 has lived an entirely different year. He put in 60-hour weeks. He navigated a technician quitting, a comeback claim, a slow February that nearly wiped out his cash reserve. But here's the twist. Assuming he survived that first year and hit his break-even math consistently, his upside isn't capped the way hers is. He's not just earning a return on capital, he's earning an owner's income on top of it, potentially $60,000 to $100,000 plus, in take-home pay depending on how the shop performs. Money his friend's index fund could never generate in a single year off $150,000. And unlike a stock ticker, he has direct control over the outcome. He can raise prices, fix inefficiencies, add a service bay. His friend can't call Jerome Powell and ask for a better year. This is the trade-off almost nobody frames honestly. The index fund offers safety, liquidity, and zero effort capped by average market returns. The workshop offers a ceiling that's dramatically higher, but only if you survive long enough to reach it, and only in exchange for leverage, illiquidity, and real personal risk that a ticker symbol will never ask of you. Neither answer is universally correct, and that's exactly the point most finance content won't tell you. A workshop isn't a bad investment, and an index fund isn't automatically the smart choice just because it's boring. It's a different risk profile entirely. Active versus passive, capped versus uncapped, comfortable versus demanding. But there's one more layer almost everyone misses in this comparison. Because so far, we've only been talking about income. We haven't talked about what either asset is actually worth if you tried to sell it tomorrow. And that number changes the entire conversation. Here's a question almost no first-time owner asks themselves before opening the doors. What is this business actually worth the day I want out? Friend 1's answer is simple. Her index fund is worth exactly what the market says it's worth, to the dollar, any day she checks. Liquidity built in, no negotiation required. Friend 2's answer is far more interesting and far more revealing about how shops actually build wealth. Workshops typically sell based on a multiple of sellers' discretionary earnings, commonly landing somewhere around 2 to 3 times SDE for an owner-operator shop. So if the business nets $80,000 a year in true owner profit, it might sell for $160,000 to $240,000. Real equity, built from nothing but sweat and smart operating decisions. But here's the catch almost nobody accounts for. That multiple assumes the business can run without him standing in it every day. A shop where every customer relationship, every diagnosis, every scheduling decision runs through the owner's head isn't really a business. It's a very demanding job wearing a business's paperwork. Buyers know this instinctively, and they price accordingly. The moment the owner walks away, so does half the value. The owners who actually build wealth here aren't the best mechanics in town. They're the ones who deliberately work themselves out of the daily grind, training a lead technician who can run the floor, building systems for scheduling and pricing that don't depend on tribal knowledge in the owner's head, creating a customer experience that isn't dependent on one specific personality behind the counter. That's the real distinction this section wants you to walk away with. There's a difference between owning a job and owning an asset. One pays you a wage for your hours. The other pays you a multiple for the equity you built, whether or not you're the one standing in the garage that day. And that distinction matters more than ever right now, because there's a structural shift heading straight for this entire industry, one that has nothing to do with pricing, staffing, or insurance, and everything to do with what's parked in driveways 10 years from now. Here's the uncomfortable long-term question nobody brings up during the lease signing. What happens to a business built on oil changes when the fastest-growing segment of vehicles doesn't need oil changes at all? Electric vehicles have dramatically fewer moving parts than a traditional combustion engine. No oil to change, no transmission fluid in the traditional sense, no spark plugs, no exhaust system, no timing belt. Brake wear is even reduced, thanks to regenerative braking doing a lot of the stopping instead of the pads. For a shop whose entire pricing model, the one we walked through earlier, depends on volume of routine maintenance work, this isn't a small shift. It's a structural threat to the exact revenue engine keeping the lights on. But here's where the story splits into two very different futures. and the split has already started. Some shops are treating this like a distant problem for someone else to solve later. Same equipment, same training, same service menu as a decade ago. Betting the transition will take long enough that it won't be their problem. Other shops are doing the opposite. They're investing now in high-voltage certification, EV-specific diagnostic equipment, and ADAS calibration, the sensor and camera systems modern vehicles rely on for lane assist and automatic braking, which need recalibration after even routine repairs like a windshield replacement or an alignment. These are the repairs combustion-era shops were never built for, and they're becoming more valuable, not less. As the vehicle fleet shifts, 10 years from now, this won't look like a dramatic industry collapse. It'll look exactly like every other disruption in history. Quiet, gradual, and then suddenly obvious. The shops closing won't be the ones that lost to a single bad year. They'll be the ones that never adjusted the playbook while the vehicles on the road quietly changed underneath them. Which brings us back to the actual decision this entire video has been circling. Because now you have every piece of math you need to answer it for yourself.